So, you want to grow your money but have no idea where to start? Trust me, you're not alone. Let me take you back to when I was 19. I had just landed an internship at a local bank and got my first real paycheck. I was thrilled. I bought new shoes, went out with friends, and by the end of the month, I was broke. No savings, no investments, just a pile of receipts. That was my wake-up call. I knew I had to do something different. So I turned to Google and typed in, "How to start investing." Big mistake. I was hit with a wall of confusing terms. ETFs, dividends, portfolios. It felt like trying to read a foreign language. I almost gave up. But then I decided to break it down, step by step. And slowly it started to click. I learned the basics, explored different investment options, and realized it's not as scary as it seems. If you're feeling overwhelmed like I was, don't worry. I've got your back. In this video, I'll walk you through why you should start investing now, the key concepts you need to know in plain English, the different types of investments like stocks, bonds, mutual funds, and ETFs, and my personal step-by-step guide to get you started, how to invest in the stock market from opening your first account to building your portfolio. Stick around till the end, and I'll also share the most common mistakes beginners make so you can avoid them and grow your money smarter. Here's something to think about. People who create a financial plan end up with 3 times more wealth than those who don't. Whether you're saving for retirement, a dream vacation, or just want financial freedom, watching this video and having a personal finance plan is your first step. Let's get started on your investing journey. First things first, when should you start investing? Here's the truth. Waiting to invest actually costs you money. Why? Because of inflation. Even at just 3% a year, something that costs $100 today will cost around $243 in 30 years. So if your money is just sitting in a savings account, it's quietly losing value while your cost of living soars. But here's the good news. You've got a powerful tool on your side, compound interest. What is compound interest? It's like a snowball rolling downhill. Your money earns returns, and then those returns start earning returns too. Albert Einstein supposedly called it the 8th wonder of the world, and for good reason. Let's break it down. In our first example, you invest $1,000 at 5% interest for 10 years. You don't just get $1,500. You end up with $1,628. That extra $128, that's compound interest doing its thing. Example 2. Now imagine you invest $100 every month for 30 years with a 6% average return. You'd end up with around $100,000, even though you only put in $36,000. That's the magic of time and consistency. Starting early matters. The earlier you start, the more time your money has to grow. Even small amounts can turn into something big if you give them enough time. So if you want to beat inflation and build real wealth, starting now is your biggest advantage. Now that you know why starting early matters, let's talk about how to invest smartly. Before you put a single dollar into the market, there are 4 key concepts every beginner needs to understand. First, risk to reward ratio. Every investment comes with a trade-off. Risk is the chance you could lose money. Reward is the potential gain. The rule of thumb, higher reward usually means higher risk. Think of it like this. Betting on a startup stock might bring big returns, but it could also flop. On the other hand, government bonds are safer, but the returns are smaller. Smart investors look for opportunities where the potential reward outweighs the risk, like risking $1 for a chance to make $3. Second, investment time horizon. This is just a fancy way of asking, when will you need the money? Saving for a car in 2 years? Stick with safer, low-risk options. Investing for retirement 30 years from now. You can afford to take more risk and let your money grow over time. The longer your time horizon, the more you can benefit from compounding and ride out market ups and downs. Third, diversification. You've heard the saying, don't put all your eggs in one basket. That's diversification. It means spreading your money across different types of investments, like stocks, bonds, and cash. So if one goes down, others might hold steady or go up. Imagine a street vendor who sells both sunglasses and umbrellas. Rain or shine, they're covered. That's the power of a balanced portfolio. Fourth, liquidity. Liquidity is how quickly you can turn an investment into cash. A savings account? Super liquid. You can access it anytime. Real estate? Not so much. It could take months to sell. It's smart to keep some money in liquid assets for emergencies while letting the rest grow in long-term investments. Master these 4 concepts: risk versus reward, time horizon, diversification, and liquidity, and you'll be well on your way to building a strong, resilient investment strategy. Now that you've got the core concepts down, let's explore the main types of investments you'll come across as a beginner. Each one has its own mix of risk, reward, and role in your financial future. The first option you have is stock investing. When you buy a stock, you're buying a slice of a company, like Apple, Tesla, or even your favorite coffee chain. Stocks have historically delivered the highest returns over the long term, about 7% annually after inflation, but they can be a roller coaster. If you're okay with some ups and downs, stocks can be a powerful way to grow your wealth. You can also invest into mutual funds, which allow to spread your money over multiple stocks, thereby maximizing the effects of diversification. Then there are bonds. Bonds are like lending money to a government or company. In return, they pay you interest. They're generally less risky than stocks, making them a go-to for conservative investors or those closer to retirement. For example, U.S. Treasury bonds are considered super safe, but don't expect huge returns. Thinking about ETF investing or index funds? Think of ETFs, short for exchange-traded funds, and index funds as investment bundles. Instead of buying one stock, you get a whole basket, like owning a tiny piece of the top 500 U.S. companies through an S&P 500 index fund. They're low-cost, easy to buy, and great for beginners. In fact, by 2023, ETFs had over $10 trillion in assets globally, proof of their growing popularity. What about real estate? Real estate can be a solid long-term investment. You can directly buy property to rent out or invest in REITs, short for real estate investment trusts, which let you earn from real estate without being a landlord. REITs pay dividends and are much more hands-off than managing a rental property yourself. A short note on crypto. Cryptocurrencies like Bitcoin are getting a lot of attention, but they're also extremely volatile. Prices can swing wildly in a single day. If you're curious, it's okay to dip your toes in, but keep it a small part of your portfolio and only invest what you're willing to lose. In a nutshell, there's no one-size-fits-all answer. The best mix depends on your goals, timeline, and how much risk you're comfortable with. But by diversifying across these types, you can build a portfolio that's both resilient and ready to grow. Let's talk about how to actually get started. Here's your beginner-friendly step-by-step guide to becoming a confident investor in 2025. Step 1. Set clear financial goals. Ask yourself, what am I investing for? A down payment on a house? Retirement? Not just growing your money over time? Knowing your goals helps you choose the right strategy and stay focused when the market gets bumpy. Step 2. Build an emergency fund. Before investing, make sure you've got a safety net. Aim to save 3 to 6 months of living expenses in a high-yield savings account. Break it into small milestones, like saving $500, then $1,000, and automate contributions from your paycheck. Imagine 1 in 4 Americans have no emergency savings, so even starting puts you ahead of the curve. Step 3. Choose a brokerage or investment app. Pick a platform that's beginner-friendly. Some great options include SoFi Invest, Acorns, Betterment, Vanguard, Ally Invest, Rockflow, and Stash. Many let you start with just $1, offer educational tools, and even automate your portfolio, perfect for dipping your toes in. Step 4. Start with index funds or ETFs. These are great first investments. They give you instant diversification by pooling your money into a wide range of stocks or bonds. They're low cost, low maintenance, and proven to mirror the market's performance over time. In fact, over 50% of US households now use ETFs as their entry point into investing. Step 5. Automate your contributions. Set up recurring deposits, whether it's $10 a week or $100 a month. Automation removes emotion from the process and turns investing into a habit. Studies show people who automate save 30% more than those who don't. Final tip: start small, stay consistent. You don't need thousands to begin, just start. Let time and consistency do the heavy lifting. But before you dive in, let's talk about what not to do. I remember how many mistakes I made when I was just starting out. It was way too easy to get things wrong. But the good news? You don't have to repeat them. Here are the most common investing mistakes to avoid. First, trying to time the market. It's tempting to wait for the perfect moment to buy or sell. But here's the truth. Even the pros can't time the market consistently. In fact, missing just the 10 best days in the S&P 500 over 25 years could cut your returns by more than half. Instead of guessing, focus on staying invested and letting time do the heavy lifting. Second, chasing hype and trends. We've all seen that hot stock blowing up on social media, but jumping on trends often means buying high and selling low. Last year's winners can quickly become this year's losers, so don't follow the crowd, follow your plan. Third, not doing your homework. Investing blindly in what's popular or what a friend recommends can backfire. Always ask, what am I buying? Why does it fit my goals? Take time to understand the company, fund, or asset before putting your money in. Fourth, investing money you can't afford to lose. This one's big. Never invest your rent money, emergency savings, or anything you might need in the short term. Markets go up and down, and you don't want to be forced to sell at a loss when life throws you a curveball. To sum it up, smart investing isn't about being perfect. It's about being prepared. Think long-term, stay consistent, and learn from the mistakes of others. Your future self will thank you. Now, before we wrap up, I want to share a few questions I had when I was just starting out, because chances are you've wondered the same things. And the answers? They might surprise you. Is $50 really enough to start investing? Absolutely. You don't need thousands to begin. With just $50, you can start using micro-investing apps, buy fractional shares of big-name companies, or even dip into index funds. Many platforms are built specifically for beginners, making investing simple, accessible, and low pressure. Is now a good time to invest? Here's the truth. The best time to start is when you have money to set aside, even if it's just a little. Studies show that people who start early, even with small amounts, can end up with twice as much as those who wait just 10 years longer. It's not about timing the market, it's about time in the market. Everyone starts somewhere. With $50, you're not just investing, you're planting a seed. Stay patient, keep learning, and remember, every expert investor was once a beginner, just like you. All right, let's quickly recap what we covered today. Why starting early with investing, even with small amounts, can make a huge difference. The key concepts every beginner should know: risk, time horizon, and diversification. The main types of investments: stocks, ETFs, bonds, and real estate. I also shared a simple, step-by-step plan to get you started. And the common investment mistakes to avoid so you don't lose money. You've got this, cheering you on every step of the way. If you cheer for our channel too and you found this helpful, give it a thumbs up. It really helps the channel grow. Don't forget to subscribe for more beginner-friendly finance tips every week. Got questions or want me to cover a specific topic next? Drop a comment below. I'll read every single one. Thanks for watching, and remember, the best time to start investing was yesterday. The second best time is today. See you in the next one.